Welcome. So I'm Liz Gatlin. I am the commercial chair here at Greater Nashville Realtors, and we are excited to host our second forum here in 2025, all about profiting in Airbnbs in today's market. I'm Southern Afina. It's a boutique real estate development company here in Nashville. And over the last decade plus, I've done over 175 million in transactions. I'm the only licensed broker and architect in the state. And so we touch everything from development, commercial, residential, and more when we are working with our clients. And then I will let our guests introduce themselves because I think they can highlight their expertise a little bit better than I can. And so we'll start with Grant here.
Hey guys, Grant Hammond. I'm with Compass Real Estate now. I spent 14 years owning my own brokerage. Before that, called Metropolitan Brokers. This is my 24th year in real estate. I have done everything from high-rise condos, which sold over 350 of those until that got boring, and then sort of fell backwards into doing these short-term rentals in 2017. Since then, we've sold 529 as of today, and mostly to semi-wealthy investors, right? We found a way after the Trump Tax Cuts Jobs Act 2017, which Chris will talk about, to use this to help shelter some of these folks' income. And it's a way that was very easy to augment and add to your normal everyday business.
Yeah, Chris Lloyd. I'm a shareholder in a CPA firm. It's a Carr Riggs and Ingram, a top 25 CPA firm. My day job is auditing, but I got into short-term rentals several years ago, personally investing in them, and so very familiar with all the tax codes related to short-term rentals and how you can benefit from those, which is why I'm here.
My name is Zach Doris. I am a commercial real estate appraiser. I've been doing it for 21 years. About 19 here, and I started my own firm about 8 years ago, and we kind of came in and started looking at these when we realized when most people were still putting residential loans on these, we came in and said, hey, look, you've got a one-unit hotel. It probably needs to be appraised as such. And so some folks are getting that, some folks still haven't, and some, it's kind of the Wild West in terms of lending for this type of thing, and so we're trying to help out there.
My name is Sharon Monterosa. I'm with Vacasa. We are a property manager. We have a local team in Nashville, and we manage 150 short-term rentals in Nashville. We have 650 in the Rocky Mountains, and we are a national company, and we manage 44,000 units in Canada, the United States, and Mexico.
Awesome. Well, so we had the best lineup we could offer you all. We have a wide wealth of information. At the end of the event, we are going to have an open Q&A. So jot down your questions if you have them as they come up. And then I'll also have to put out a disclaimer. Even though some of us are tax professionals and other professionals, we are not offering legal advice or tax advice or even broker advice. So always consult your attorney, your CPA, your broker before going out and just advising people on investment strategy, because that's what we should do as realtors. Okay, we're going to go over Nashville Airbnb rules and laws. We're going to go over design trends that are hitting right now in the market and how you can really set your clients or your Airbnbs apart to increase bookings, and then proven best practices for maintaining revenue. All right, let's start with understanding Nashville's STR rules and laws. There's been a lot of changes here over the years, and we have a lot of expertise. So what major things have changed in the market over the last 5 years?
Well, let me start on that for the Nashville laws, especially. Who remembers type 1, type 2, and type 3 permits, right? So it's confusing because when we first started this process, there was a certain percentage of real estate in each district that could be a short-term rental. And that all of that goes away. So forget all of that knowledge that you had for type 1, type 2, and type 3. Now it is only the owner occupied and non-owner occupied buckets. So when you see NOOSTR on a listing, they're talking about those non-owner occupied short-term rentals. By the way, when you list something on the MLS, please, Lord, use that NOOSTR so other people can find your short-term rental that is investor friendly, right? That means that an investor can come in and get a new permit. So since we switched over to the non-owner occupied and owner occupied, there still have been a plethora of rules passed by Metro Council and also in other municipalities. So, Oak Hill, it does not allow short-term rentals. Bellmead does not. So we're only talking about the Metro Nashville, Davidson County. We're not talking about Berry Hill, which has their own set, or Brentwood, or any of those other places. But they've passed 17 laws since they went to non-owner occupied and owner occupied. The vast majority of them aren't very tricky. The only things you really need to know is that it's a maximum of 4 bedrooms that are permittable, a maximum of 12 residents that you're allowed, or guests that you're allowed to have in each one of these Airbnbs. And then the trickiest thing is you can't be within 100 feet of property line to property line of a church, school, daycare, or park. And that's what really trips people up. They think that they can have a short-term rental within that. And that's owner-occupied and non-owner occupied alike. Can't be within a church, school, daycare, or park. The biggest difference between owner-occupied and non-owner occupied is zoning, right? You've got to be for non-owner occupied in commercial zoning. And Metro has a really nice zoning. I don't know if we put it in the slide deck, but Metro has a very nice PDF on their website that shows you where non-owner occupied is allowed. So think of all the commercial, mixed use, office, residential, intense districts. DTC, of course, is where you can do these things. For owner occupied, that's where the rules start to get a little bit looser and a little bit more confusing, to be honest with you, because you start to talk about things like, can I have an owner occupied permanent residential district? The answer is usually yes. But if it's an HPR and you don't own both sides, the answer is no. And there's other tricky little things like that. And so because those rules change so much and because they've gotten tricky, we have trained an AI to answer all of these questions property by property, that goes in there and searches the property records for you and gives you a most likely answer. You still need to verify it, but we trained an AI that I think we have link up there for you, that you should absolutely use as your first stop. So if you have any questions about zoning, or if it's owner occupied or non-owner occupied, or even potential income, we've started training this thing based on some data from Summer OS to tell you what the potential income would look like on that thing. So it's a good starting place.
Sure. Other panelists, y'all have probably seen a lot of changes here in the last 5 years in the Nashville market. What's kind of one of your top changes that you've seen or experienced in your business?
One thing Grant brought up was the regulation about you have to be 100 feet from schools, daycares, and churches, and that gets me every time. You're talking to clients, and I look over and there's a school, and I'm like, oh, So that's one thing I would really be on the lookout for.
One trap door I think we were talking about when some of the laws came in is the uses that are grandfathered in as non-owner occupied short-term rental that were there before in a residential zoning. One of the kickers there is if that property ever sells, you cannot actually get that permit again. Another person who owns it can't get it. So don't go out and market it as a short-term rental with this history of revenues if it's not actually going to get a permit for the next user. That's one of the things that we kind of got into. People saying, well, here's this short-term rental. Here's these 3 years of historical. It's for sale to these people who are going to operate a short-term rental. I'm like, no, they're not.
And so one of the notes you'll see is that the permits are not transferable. How have y'all been seeing things change with, I know a lot of businesses own short-term rentals and they'll just sell the business. Have you seen any pitfalls in that regard on not getting that clear transferred?
We'll start with you guys.
Yeah, I mean, we got into some of this because what you're saying there is if it so happened that before those rules and regulations came in, the property was actually owned in an LLC. And what some people are doing is they're transferring the LLC itself. What we found was a lot of lenders were like, no way, Jose, because they basically said, we are not lending on an LLC, a business that happens to have an asset in it that is this only. We want to lend on the asset itself. And so it kind of, that was one of the things that we saw get shut down quite a bit. It doesn't mean that they don't transfer. It just means you probably need to get really creative in the financing for it to do so.
It's from a lending perspective. So part of what I do is audit banks. So from a lending perspective, it's actually a completely different product on their side. So it actually is a completely different loan that you're trying to look for versus like a commercial
It's a business
property. Yeah, it's a business loan. It's a
Yeah.
small business loan,
Small business.
not, and it so it acts completely different. They have to underwrite it completely different. So it really is a different challenge, but it can be done. I've seen folks execute it.
Mm-hmm.
There is a workaround product that's a DSCR loan.
Yeah.
And the DSCR loans is what we normally see a borrower use when they purchase an LLC. And when they buy that LLC, again, they're buying the business, which happens to own the real estate, which happens to own the permit, which happens to own the furnishing, which happens to own the bookings, which can also be cross collateralized with whatever else that person was doing in their lives. And it could have been pledged for a car loan or another residence. And so when you do these, you need to work with a title company who is used to vetting these a little more deeply. Don't just go to your normal run of the mill. You need to go to a specialist who knows how to make sure that there's not those pitfalls that will come back and bite your client in the behind.
Actually, related to the DSCR loans, not every bank has that traditional DSCR product. So it's also finding the banks that have that DSCR in that manner that utilize it for short-term rentals. It can also be a little bit different. But what you'll end up finding is a lot of folks, after they've got 1, 2, 3, 4 Airbnb short-term rentals, they start to move into the DSCR products more often because they can't get the residential loan that everybody kind of wants, that 30-year fix. So they end up dealing that DSCR route a lot.
Sharon?
I would say in commercially zoned buildings, condos, if the HOA allows and it's considered a short-term rental building, the new buyer, new owner can obtain a permit and not transferred from the seller. Now you have to expect maybe 4 weeks for that permit to be issued. And you have to go through, an application process, just documents, and then also a fire inspection. On owner occupied residential, maybe, you have a client who's looking for a home. Mid-century homes, 1970s homes, look at the windows because you have to have an inspector come in and you have to have a solid egress, a window that's quite large actually, that will probably not be in those homes. So just know that, and that's what I'm here for with Vacasa and Grant too. I mean, we can vet that for you on the front end.
Right. You'll notice that all of the owner occupied, not only do they have limits on the numbers of people, but even when you go, like a bedroom can't be counted a bedroom unless it has that egress window, unless it has it makes some basic life safety codes. Smoke detectors are a common killer that kind of pops up last minute. And then on the commercial side, it has to meet all of the commercial regulations architecturally and life safety wise. And that's when you can transfer it because the commercial property is carrying that non-owner occupied.
So this is a real scenario. You're speaking to a client from California. I want to buy an Airbnb. They're looking at a residential home in East Nashville, and you need to stop right there because that's owner occupied, and they're going to have to change their residency completely to Tennessee to be qualified to get that permit. So,
And they don't live there 51% of the time. My in-laws live in East Nashville, and their neighbor sold, and someone purchased, and then all of a sudden they started painting the house pink, and everything's pink, and there's the rocks outside are pink. I'm like, I bet they're trying to Airbnb that, and they live in the area, but they do not occupy that home, and they continue to try to get that owner occupied permit. We'll see if they get away with it, but it's unfortunate that someone did not advise them that, hey, you can't do this, because now they've got a neon pink property and a lot of pink going on that I don't think they'll be able to rent long term anytime soon. All right. Can y'all all share at least one horror story with us with a pitfall that you have learned from over the last couple of years in the Airbnb market?
I've got a random one. You've probably seen in a lot of these condo buildings, we are building bunk beds over washer and dryer areas to increase the heads on beds. And you also probably likely know that the fire marshal's office turns over quite a bit. And while there is not a law on the books and a fire safety law that says you cannot have a bunk bed over a washer and dryer, certainly certain fire marshals and or employees of the fire department feel differently about that. And so I had a client recently who was the 17th owner in a 24 unit building. So 16 people before did the same thing and got their permit. They spent tens of thousands of dollars on this short-term rental, built that out, made it pretty, went and got their permit. Fire marshal came for the inspection and failed them and made them rip out everything that they had done in that bunk area and return it back to a washer and dryer. And or they could have kept it a bunk and then gotten rid of all the washer and dryer stuff, capped it off, closed it off, called the electrician, done all the things. And so even though that's not a law, so this is a horror story because this is sort of an evolving industry that not every codes department, fire marshal, not everyone has figured it out yet. It's still really new in Nashville, and so you are going to run across those things. Just be calm and cool and collected, and we worked our way through that one, and then we reacquainted ourselves with the current fire marshal. And now it's not an issue to do that, to build a bunk above the washer and dryer, but it's not part of the fire code. It may become it, but at the end of next year.
Well, I know the fire codes are changing this year. They've already switched over. And then so with codes and permitting and everything, it really is about relationships. If you have someone helping you with those relationships, it goes a long way if you do run into things, because everybody down at codes will interpret my architectural drawings differently. Sometimes I get lucky. Sometimes I'm in the weeds with things that really aren't an issue. So
Yeah, everyone in the Smoky Mountains just went through code changes / are going through it. So definitely relationships. I got a random one for you. Similar. What y'all are selling is also not just a house. It's a business. I mean, it is a hospitality business. One of our first house, we had a 15-year-old throw a throwing axe through our air conditioning unit in the middle of COVID, and we couldn't get a new air conditioning for 4 months. Right. So now how do you manage that and dealing with future guests and all this stuff? And it really, I mean, it becomes a business, and whoever's dealing with that and managing it, they're having to take their time. So there's your random pitfall that there's a lot of things that can happen. That's just one of many stories, but trying to navigate that and keep your 5-star rating so that Airbnb and VRBO and whoever else keeps you at the top is a challenge.
I would say mine's a bigger picture. It's more of a macro, kind of just doing your due diligence on supply demand of these types of units. We saw one. I think it was like a 5 or 6 unit build over in East Nashville, kind of in the gold rush days, and the first unit, great sale. They went in, an owner picked it up. They immediately went out, outfitted it, and I think they're $250 ADR, average daily rate. The other 4 or 5 units were still available, and within a few months, an out-of-town buyer came in, picked them all up on a 1031 tax exchange, went in, outfitted them, and started charging $175 ADR. And so, unit number one, first buyer, they had no choice. They just lost 20-30% of their revenues off the top because of the 4 or 5 other units in there where this guy, he just didn't need the kind of margin that they did. And so they were plumb out of luck. And so for them, it was an almost immediate loss.
That's a good point. I mean, because you're pricing based on your comps, just like in real estate and what the market value is. So in that case, they did have to drop. I don't run into it. I have run into it with the HPRs where somebody buys, side A, and they're hoping to short-term rent, and then of course they can't. You have to own both sides, but they were not provided that information up front. And if you own both sides, then one is owner occupied or you're living in it, and then or you long-term rent, and then the other side you can't short-term rent. So that's a real issue. And then even yesterday, I had an inquiry. It's a gentleman from New York. He's bought a home in Buena Vista, and I can tell he believes he can short-term rent, but it's definitely going to be owner occupied. So that information was not provided to him. And probably the previous owner, the seller, did have a permit. But unless he changes his residency to Nashville, he will not be able to. So I'm going to have to deliver that information to him.
Let Brandy.
Yeah.
Do you think there's anything that person could have done to set themselves apart, though? I mean, we see that so much that there's so many units that all look the exact same. They'll be right next to each other. But if you can do something to your place, whether it's indoor, outdoor, pictures, I mean, the pictures sell, right? At the end of the day, I think that's what it's all about. And that's the half of it. And the other half is making them happy while they're there. But if you can make your place stand out from the other 5, I've got a person right next door to us that's extremely similar, but ours just stands out. We do a third more than they do in revenue. So there's an opportunity, even if the person next to you has the exact same place, if there's just isn't nice.
We get into, and this is one of the most complex valuations that we do, because what you're talking about there is the sticks and bricks are the exact same. There's no difference in the real estate itself. What you're talking about is increasing the intangible asset value of that business. Like Chris said, it's a business that's there. So perfect example. It was similar thing, 4 or 5 units in the same. They all look the same. One unit had an ADR of $450 a night. The rest of them are like $325. So of course we're like, what's going on? Well, we go in, they design this whole thing. There's like all these little sitting areas for these brides and their bachelorette party to sit in the kitchen and all do their makeup at the same time. There's cool painting. It's like the pink everything, but pink and black. And there's a sign on the wall in neon that says, "Good girls go to heaven, bad girls go to Nashville." And I mean, like, that's the sign, right? That was rent this space. That was the front picture. It wasn't even the real estate itself. It was a neon sign. And their ADR was, I think, 100, or not, it's probably 30 or 40% higher than anybody else. And it had nothing to do with the real estate itself. It had everything to do with the business branding and the intangible asset value that was being created there. So, what we were talking about earlier is your potential buyer. They're probably upper echelon income earners. They also are creatives. Attaching ideas to these types of units is really how you can create oversized returns. And we're getting ahead of ourselves because we are talking about a little bit more, but I have yet to see anybody do this. I'd be interested to hear what you guys say about this. But if you think about it from a macro standpoint, a lot of these attach ideas. You're for the bachelorette party, or for you've got the game room and all the different, stand-up video games for a family of 16 or whatever. Broadway is doing something that's similar, except they're not attaching ideas, they're attaching people to their real estate, right? You got your Garth Brooks, you got your, Eric Church, everybody's got their bar. And I have yet to see anybody actually attach like smaller minor names of, everybody raise your hand if you kind of know somebody halfway famous in Nashville, right? That's the point. You could actually go to those people, and I think if somebody wanted to do this right, they could say, hey, let's create the Chuck Berry Museum. And it's a short-term rental. You can come stay, and all his stuff is in a glass case. If you can find people to go into business with that are, somebody, they might have any kind of following whatsoever. You literally attach a name to a short-term rental and create the branding. That's all it is the branding of a person rather than an idea.
I think one thing you have to think about is uniqueness, like you're mentioning. Also, this is a business, so create social media pages for your Airbnb. Also, your own personal brand. I'm with a corporate property manager, but Superhost. Superhost in say there's a 55 unit building. You're a Superhost with a 5-star rating of all these reviews. You have a unique decor, unique theme. You can get that higher rate for sure. And because we're an urban market, we're an Airbnb town. That's where most people go to focus Airbnb. Whereas the beach and mountain markets, a lot of people go to different places. Marriott or go to different sources, online booking channels. But one thing that I even met with somebody the other day, it was like, you need to do social media for your home.
Mm-hmm.
And then have a place where people can take photos and Instagram it, and then create some talk about it.
So that is the perfect transition into the top 5 Airbnb design trends right now. Number 1 is that local, bold, branded theme that you were talking about. And it needs to have a catchy name. So you can't just slap an address on something anymore. If you are marketing a business and your product is your Airbnb, it needs to have a name. It needs to have local flair because people are traveling. And then it needs photo walls for your niche audience. Just like businesses don't service everybody, realtors don't service everybody. If you're really successful, you're going to go after your niche, whether that's bachelorettes or country music fans or sports fans. I mean, you can have a hockey Airbnb, but you gotta do it right and you gotta really just go for it with design. The second one is personalized luxury. If anybody has traveled, you know how frustrating it is if you are sleeping hot and the sun is blaring in the morning. Today's travelers are even more tech focused. So you want the automatic locks and the check-ins, you want the Bluetooth speakers, and you better be providing an upscale experience for everybody. And so that means extra bedding. That means extra cords. Everybody forgets a cord. You don't want your guests going out and cussing you because they can't charge their phone and they missed an opportunity. The third one might surprise you all is that there is a huge interest with travelers and people like in health and wellness. And that comes down to not just physical health and wellness, but eco design. So live plants, fake plants are kind of a thing of the past with your Airbnb. They might look pretty on the photos, but you got to figure out how to get great air quality. So many people have allergies, especially here in Nashville. Spa and fitness options will really make your listing stand out. I've seen people have gym setups. That's going to be a new thing that continues because why would I stay at your Airbnb if I work out every day? you don't have anything for me, and I'm not bringing my weights. But the hotel down the street with competitive price point has a gym. And so really honing in on those wellness features. Group spaces are a must. On Grant's listing earlier, they put a hot tub on every single one because that's probably all they could fit. Greenery, outdoor spaces, place where people can gather. So even if you're only sleeping 2, you want to plan a seat for 8 across the board. And so having the ability to have more people in the Airbnb than the beds is something that is catching on in design, because it might just be me and my husband visiting somewhere, but what if we want to go meet up with friends and our Airbnb is downtown? They don't, we don't want to drive that all the way out. We want them to come to us. So those larger spaces and larger designs are a thing. And then flexible on demand is the new thing. People want what they want when they want it. And that's because of our instant gratification market. I'm sure on the property management side, y'all deal with this a lot. But people want to blend business and pleasure and leisure, and they want it now. And so giving them an opportunity, I don't necessarily, even if it's a branded area, if I'm doing business, I don't necessarily want my kids playing hockey ball in the background. And so adding some different elements, and just always think, what would a hotel do? And that's where at Southern Anything, we've designed multiple Airbnbs. What are the trends going on in hotels? Go visit some hotels. They don't look like residences. Your Airbnb is a hotel. It should not look like a home. Mm-hmm. And so those are kind of our top ones. I know on the free resources, you can download my full checklist. It's about 5 pages of things you need to also have, from little, how many scissors you need to have, to some of the bigger picture things that you can get really creative on. And we're going to move right into our proven best practices for maximizing revenue. And so we can stay on track. And I know our panelists have already discussed some of this, but what is the number one thing you suggest to maximize Airbnb revenue in the current market?
It's overshared. Yeah.
Just going back to design real quick. Doing an executive apartment is a killer. If somebody is truly an investor, just wants to buy and start renting, and they're not a creative, they need to hire a designer for sure. A lot of these beautiful places that you see, a designer did it. You do have those that have that touch and that creative side, but just throwing some beds and some great couches is not going to do it anymore. You definitely have to elevate. And I think the rule of thumb, would you say, is $8,000 to $10,000 per bedroom, maybe at the cost, and that's just like basic elevated style. It would probably 4-bedroom townhome would probably be about $40,000 to $50,000 spent, easy. If you wanted to go super elevated in luxury, I would say 80, easy. So the buyer really needs to consider that. Maximizing, I feel you should always maximize to your occupancy. So as Grant was saying, a 4-bedroom can sleep 12, a 3-bedroom can sleep 10. So they really need to max out that occupancy. And then, as Liz was saying, have these areas where people can congregate. The Lyric townhomes are known for, you have your rooftop, but you also have a garage. The garage isn't for the car, and the garage is a playroom. So just have different spaces for the people paying it.
And touching on that, the number one way to increase your revenue and bookings is professional design and photos. And it goes back to that. The design is what's selling it, and the photos are what is pushing it out there. If you're skipping and you're just, oh yeah, my wife's a designer, she can do this, you're literally leaving money on the table with your bookings. And even the professionals in the room, know we'll still hire a designer because sometimes you just don't know. You're stuck looking at the same thing and you're not thinking outside of the box. And that's where those professional services make the biggest difference. That's the number one way to increase your revenue when you look at all of the stats out there.
All of this is choosing your target audience, right? Picking your avatar and making sure that everything is designed for that person, group, whatever it is. For us, we do luxury family vacations. So ours is very different than like your bachelorette party or your 3-person executive or whatever it might be. Ours is all about, multi-generational family. So it's a different feel of what we're going for. So it is all about who are you trying to sell to and then maximizing everything for them, every bit of it. So.
And that is one of these best practices is offer flexible stays and extended booking rates. Going back to that, people want the flexibility in their design. They also may need to stay an extra day, or they may want to say we're staying a week, we're staying a couple of extra days, and offering opportunities for them can really just, that's one vacancy now is full, even if it's at half price. What are some of the financing, tax, or investment opportunities that y'all have seen that are really making a difference? One of these slides said bonus depreciation. I'm sure you can speak on that, which a lot of investors capitalize on. But what are some other things that we haven't thought about?
You jump in the tax stuff?
Please.
All right. Good. Yeah. Okay. Let's show what. Yeah. So, especially in the past, but so the biggest piece to acquiring these, if you have a high net worth individual, actually, let me even back up. All of y'all are considered real estate professionals. I cannot be considered a real estate professional because I have a day job, K1 W2, that I'm not spending the majority of my time doing real estate. So if I go buy a house and depreciate it, a long-term house, a normal rental, I can't utilize that because it only offsets passive losses, or it only offsets that loss of depreciation, only offsets passive income. Where for y'all, that can actually offset your active income, your day job, when you went out and sold a home, right? So since you count as real estate professionals, that'll work out great. For non-real estate professionals, doctors, lawyers, accountants, whoever it might be, if you've got a high net worth individual, how do you get that passive income to cross over and offset their salary? And it's short term rentals is the answer. So if it's long term, if it's under 7 days, which is what all of this short term rentals, anything over 7 days is considered a long term rental and stays in that passive bucket. If it's, you have a flyer that will help explain this. Amazing.
Have an additional resource.
If you get that short-term rental that is under 7 days, now all of a sudden that's considered an active rental, right? So we can consider it as offsetting our active income. So that depreciation is going to create a loss. And so here's kind of a high level how that would work. If somebody goes out and buys $1 million property, you can do what's called a cost segregation study. Typically, if you didn't do that, you would just take that $1 million, divide it by 30 years, and that's your normal depreciation. But if we do a cost segregation study, anything, they're going to allocate different buckets. They'll say some of it's 5-year property, some of it's 7 years, some of it's 15, some of it is 30-year property. All of that lower year property, 5, 7, 15, can be depreciated under bonus depreciation today if the laws are set correctly. In 2020, they were set correctly so that you got 100% of that number. Today, they're only at like 40%. So we start with $1 million property. About 25%, 20 to 30 will get dumped into those lower buckets, 5 to 15 years. So you say about $250,000 could be depreciation if you add 100%. And if somebody made $250,000, we just created $250,000 in loss. They wipe each other out. That person owes no taxes, just like that. Today, that's 40% of that 250. So now you're way less, and it doesn't offset the full 250. With that said, all of that was it was under the TCJA, which I don't know if you've heard. They're trying to get that re-implemented. Hopefully it will just be the full thing was re-implemented. We'll go right back up to 100%. Hopefully it'll be permanent. We will see. That hasn't been determined yet, but that's definitely something to kind of watch out for in the tax regulations. I have heard it's on the table and that it was going to be retro back to January 20th, 2025, but who knows where that lands. So, if the tax laws get pushed and it goes back to 100, again, you could buy $1 million property, get 250,000 in loss and offset 250,000 just like that. The other caveat to this, and let me back up and say, a lot of CPAs don't know this, to be honest. I mean, a whole lot of CPAs. My prior firm, I asked our real estate professional, and he was like, "Oh, you can't do that." I'm like, well, actually, you can. And here's the video. And there's been audits. The IRS has audited this. The people have won. It is law. You can do this, but you need to ask your CPA. Your clients need to ask their CPA specifically about this, and do they know this particular version of that law? Do they understand that interpretation before they go and utilize them? One last piece. So the last caveat to this that also saves them an extra 15%. So since this is a business, you owe self-employment taxes if you go over here and make income. There's a lot of discussion on if it should stay on Schedule E, which is rental income, which is where all your long-term sit, or if it should move over to Schedule C. You don't want it to be. Y'all are Schedule C. Yours is going to be Schedule C because you're real estate professionals and it's your active business. I want mine to stay on Schedule E because if it's on C, I owe another 15.3% in self-employment taxes. The great thing about this is it's still rental property, so I can keep it on E, but it's an active business, so I get to offset C. So it's like perfect, right? Which is why I/anybody else that's not real estate professional should utilize this if we get back to that 100% as a huge, huge bonus. I mean, basically, I get 25% free down payment.
So this is in the last year or two when we value these things, to be perfectly honest, having realistic pro formas on your revenues and that sort of thing needs to actually happen. We've seen decreases in these revenues, these ADRs, these occupancies over the course of the last couple of years. Okay. For us, looking at it, amazingly enough, we go, these sales prices aren't really moving off of what some of them were selling for. And we could not figure this out. This is why. Because we always only get to download to what we call the net operating income on an asset. That's what we're looking at. All this tax depreciation is what they call below the line of the NOI. These things are moving into not just a real estate investment bucket, but into a whole nother world where you get all these benefits that we can't even really make sense on paper. So as an appraiser, I have to say the highest and best use of this property is the first time in my career I've ever said this. The highest and best use of this property is an investment property. And we get down to the bottom line and we go, you should not buy this on an investment property basis. It's a bad return in comparison to all the other assets that you could buy in real estate. But none of the other assets in real estate you can do this with.
Yeah.
And so it's this kind of wild thing that's occurring. And so I'm learning from Chris. Like, I've been calling him and being like, hey, can you help me out? Help me understand this. Help me understand this. So
Well, to that point, in 2017, 18, 19, 20, 21, a lot of investors in Airbnbs really didn't even look at the tax benefit. It was like just kind of a bonus, right? And your cash flow was so high. Well, I mean, the prices have gone up, the rates have gone up. All of that has been squeezed. And so you can start seeing everybody, their calculations are getting a little more creative. It's like, well, I also get my bonus depreciation and I get this. And so it's becoming even more and more than it was a huge benefit then. But now it's even more and more of a benefit just because it may be the only thing sometimes that's getting them there.
When you're comparing it to a typical commercial investment, a lot of times the numbers aren't necessarily making sense until you factor in some of the tax advantages. And we have seen a change. It was just a couple of years ago, we actually hit a peak market for our hospitality industry for hotels. And we still had tons and tons coming online over the last 3 years. So if you think about residential as a market, when you hit that peak, things are going to either start stabilizing or kind of coming down and settling down. When there were more hotels than demand coming online, then that's when we started to see some owners struggle with figuring out the revenue model because they'd squeezed all the taxes and now they can't really sell the way they had anticipated at the prices they wanted. But if you work with a really good team, whether that's property management, CPA, and lending team, and your agent can help you navigate some of those things, you can really maximize your revenue and come out on top where a commercial guy can't do that because it's very difficult to change use.
One caveat to this that I totally forgot to tell y'all. So to be able to do this, again, I can't be real estate professional, right? But in order to be able to utilize this and move it to your active business, you have to be active in that business. And so your clients have to be active in it. So and it can be the doctor or the doctor's spouse. It doesn't have to be the person who's bringing in the money. As long as they are married, filing jointly, it can be either or. But they have to have 100 hours and more than anybody else to be able to count that and to be able to take that bonus depreciation and move it from passive to active. If you use a property management you're still passive. You bought the property, they're doing the thing. You're still passive and you can only offset passive income from investments or whatever else you've got. If you're actively managing it or if they are actively managing it, then you get to utilize that. So the perfect scenario is you buy it end of November, you set it up, you put over 100 hours in it and more than anybody else. And I can explain that in a second. And then you rent it out. So it has to be put into service and then you rent it out and you get your bonus depreciation. The more than anybody else caveat is even if you're not using a property management, like mine are all 3 or 4 hours away. So I don't use a property management, but I cannot go and clean it. I can't do the maintenance. I've got teams of people that do all that for me. So my 100 hours still has to be more than all of theirs individually. Or if you have a team of cleaners, let's say you use ABC Cleaning Company, it's not ABC Cleaning Company that has 120 hours and Chris has 100. It's Lisa or Bob that works for ABC Cleaning Company. It's the individual of those cleaning. So it really isn't that hard. And quite honestly, I use the same cleaners. It's a small family team, and I can still, at 100 hours, I can still have more than them individually. So it's not that difficult, but you do. That is the one caveat to that. You've got to be self-managing on that side.
What Chris is saying is you just need to call him because it's a lot of details and you don't want to step into something and not document properly and find yourself, you thought it was one thing. Sharon, you had another takeaway here.
Yeah, if you're new to selling investment short-term rentals, it's better for you, honestly, because you're not going to see those huge numbers related to revenue and income. It's more to be realistic with the buyer is important these days, especially as inventory has expanded. I would also lean away from one bedrooms. One bedrooms compete with hotel product, and as you know, I was just saying to Zach, I started in the hotel industry here 30 years ago. I never would have expected Westin and JW and pool parties and rooftop bars. So the 2, 3, and 4 bedrooms are more lucrative. I mean, there is value to one bedroom for whatever reason. I talk to people, buyers from maybe they have a child who's going to Belmont, Lipscomb, Vanderbilt, TSU, and they want a place for 4 years to rent and stay in. And usually their child will move in maybe junior and senior year. 1031 exchanges. Maybe the buyer's is working. They split time between New York and Nashville. So there's lots of different reasons for people to want to invest. So, but there are over 7,000 short-term rental permits active in Nashville. But it's just like the real estate license. Who's really active and who's not. But that's
Well,
not
both types. Most of them, the majority are owner-occupied
Yeah.
permits.
Yeah,
And not owner-occupied. Non-owner-occupied are being squeezed by, zoning
Right.
opportunities and that sort of thing. But let me build a real-world example off of Chris's $1 million property example with $250,000 bonus depreciation available on that property in year one. So, well, let me back up one more step. So I think you know that the House and the Senate have been working on a new Tax Cut Jobs Act Part D, and that it's likely that 100% bonus depreciation comes back for this calendar year, which is probably why you're sitting here right now. They're both working on the consolidated bill right now, which will be presented on the floor and debated likely in July. So you don't have very much longer to get up to speed on this stuff before it's here, and you'll have 5 months to get these properties closed with your high net worth individual clients. So building on that urgency, here's what a real life example looks like right now in today's marketplace, which is a little bit oversaturated with new construction, right? Because interest rates went up, made it tough to make the numbers work. 40% bonus depreciation, defrays that a little bit. But like the active buying and selling, I think you probably see it all in your own business as well, is depressed at the moment. Got a lot of people sitting on the fence. This is something that pushes them off the fence really fast. So if you go and buy that $1 million property, there's $250K available for bonus depreciation from that property. That's things like fixtures, flooring, wall, cabinets, appliances, roofing. It all gets cost segregated by a professional for around usually $2,500 to $5,000, depending on who you're working with. It gets cost segregated into those buckets, that 5-year, 7-year, 15-year bucket. That 5 and 7-year bucket is what you can depreciate in year one. That's your $250,000. Then on top of that, you furnish that unit. So that's all your FF&E. That's your furniture, fixtures. It's all that stuff. All of that stuff is also bonus depreciable. So in his real world example, you buy a $1 million 4-bedroom, 4-bath townhome that has a hot tub on the rooftop with views of downtown, that's in a walkable neighborhood, and you spend $100,000 with a short-term rental designer who designs this thing and does all the things on the furniture, makes it beautiful, paint on the walls, which is again can be depreciated, all the things, everything you do this thing. So you're going to end up with around $350,000 of depreciable value in year one. So that's a big part of the math for these folks. The next part of the math for those folks is what does it look like in year 2, year 3, year 4, year 5?
And that can't
Actually,
doesn't it?
Yeah, actually, pause it right there. Year one, you still get to depreciate that the other 75%. So it's really 250, 350,000 plus another 50,000 or another 40,000, whatever that math works out to. So it's not just the 250, that's just the bonus piece. So then you take that 50 and that's year one, the rest of year one, year 2, year 3, you keep getting that 50.
So it keeps going. And so that's why the horizon of ownership on these typically is 4 or 5 years. And then you see a recycle from investors. And so the next piece is you've found there's several designers who specialize in these short-term rentals. You've designed this gorgeous, beautiful short-term rental. You've owned it. You've now owned it for 3, 4, 5 years, and now you're starting to wane a little bit on your income, right? You got that first couple of year bonus from Airbnb or VRBO. What do? You recapitalize. You have to refit. You have to do something different. New photos. The first 5 photos on the listing are the most important 5 photos you'll ever take in your entire lives. So these need to be fantastic photos. It needs to be your hero shot for your first photo. You need lifestyle shot. And I don't know if you've scoured Airbnb or VRBO listings lately, but you're going to see downtown Broadway shot on the 3rd or 4th picture. Or you're going to see something fun that's nearby that people can walk to, a restaurant, a bar, a Topgolf, whatever it might be. So you are selling not just your unit, you're selling your area too. And you're selling the fun. You're selling Nashville, to be honest with you. So in those first 5 photos, you need to accomplish all of that this is a badass place in a badass part of town that's going to be a badass good time. You got 5 photos to do that. On your description, the algorithm doesn't say this and it's not proven out, but a lot of managers now are changing their descriptions quarterly or so and rewriting descriptions. I don't know if that works or not, but it seems to in some cases. And so,
Tinkering in general,
yeah,
seems to you're active.
Yeah.
You're doing something.
and don't go to ChatGPT and have it rewrite it itself. Rewrite it yourself. ChatGPT, I don't know if you guys know that, inserts little pieces of code into it so that bots can read that and know that ChatGPT wrote that. So if your social campaign has been nothing but ChatGPT cut and paste, you probably haven't been very successful with it. If you ChatGPT it and then you go ahead and type it out, you're going to be 2x more successful. There's your realtor tip of the day. But same thing with the listings on Airbnb. Airbnb is a tech company. Don't forget, they are a tech company. They don't own any real estate. They are a tech company. You're not going to trick them by copying and pasting stuff on there. So go in there, take the time, write, and you seem to get a pretty good little boost out of that. And then there is sort of a natural life cycle. I think Sharon would probably agree. There's sort of a natural life cycle of these Airbnbs where eventually it feels like the platform is kind of puts you at a level, and then no matter what you do, you kind of stay there. And that's when a lot of my clients will sell and then re-up, buy a new one, do it all over again, and or sometimes switching management will give you that same boost, which is weird to say. And it's not the management company's fault. There's just some kind of stale bagel logarithm. I don't know what it is, but it just sort of happens. And so when you see like certain management companies coming in and out of favor, like some of that is, it's not like those management companies were terrible or did something wrong. Some of that's just this stale bagel effect that is inexplicable with the algorithm. We're all trying to figure it out all the time. There is no public information on the algorithm. We're trial and erroring, A/B testing constantly, kind of thing. So adding new pictures every so often, always good. Switching up your description, always good. And then at the end of your life cycle, when you're talking to this investor who's bought this $1 million property, who spent $100,000, who took 350 of bonus in year one plus 50, so they took 400,000 off their taxes, which makes you a hero, by the way. And bona fide, not all heroes wear capes. Makes you a hero, and then another 50 in the next year, another 50, another 50. When they do the holistic math, even if that Airbnb just kind of broke even or made a little bit of money, when they do that holistic math and they sell that property, it was a huge benefit for their full wealth planning for their families. And that's where my client base is. There is a whole nother client base that are the hustlers. They can just make shit happen. And those people are some of the most successful hosts on the platform. They're 5-star Airbnb, everything up, they're 4.99 above super hosts that are guest favorites, the whole thing. What I'm seeing, the biggest trend I'm seeing from these hustlers is the use of QR codes throughout their place. So if they have a washer and dryer, the host goes, "Hey guys, it's Grant. I see you're trying to use my washing machine. Are you having trouble? Guess what? If you hit this button and this button and you go on a spin cycle, thanks for staying here." You're going to see a ton of QR codes all over those places, and they are selling themselves and an experience. I walked into one the other day that I was going to resell, opened up the pantry just to see what was in there, and there's a QR code. It said hungry with a QR code. Oh, cool. I watched this thing. It's like, "Hey, Grant, here's my favorite restaurants that are walkable within here. Why cook when you can go and get a professional, prepared meal for under $15? And it was like Redheaded Stranger and a couple of other stuff. I was like, yeah, Redheaded Stranger does sound good. So I left that listing appointment and went and ate at Redheaded Stranger. So they're very effective. And so
they're playing to their demographic.
Yeah, the hustlers can kill it in this business. So I know we're talking about high net worth individuals a lot here, but the hustlers are really the ones that can get massive revenue. So don't discount a 20-something who says like, "I don't have a ton of money to put down. I guess I'm not buying one." Well, there's DSCR loans that are available for those folks. And if they are hustlers, they may end up buying 6 or 7 of these from you when it's all said and done.
I can attest that probably 5 or 6 years ago, we appraised the Urban Cowboy, which is a small boutique hotel with about 7 rooms. It's an old house over in East Nashville. The rooms were literally like, I want to say some of them were like 100 square feet. I mean, it was literally just like a closet. They put a bed and a clawfoot tub in, and that was it. And when we got in there and looked at it, the revenues were, and this was 5-7 years ago, $400 a night. And there was not a single comp in East Nashville. There was not anything in the city other than the Class A high-rise hospitality uses that were getting this kind of ADR night by night. And as we dug into it, what we found was the owner would throw a party every Saturday night, and anybody who was staying was invited. He would also invite other people. There's guitars on the wall. They would get together and have a jam session, and it became desirable, so much so that the lender asked us to give 2 valuation scenarios. One was with him there, and one was without him there. And it was 2 different numbers because he himself was part of the value to that real estate. So it's the hustlers can make or break, and it was a chunk of money. I can't say, but it was a chunk of money just with his presence or not.
One thing that can really make you stand out is seasonal boosts, and that's seasonal photos and decor. So if you plan just a quarterly marketing switch up, decorate for the holidays, capture the photos in Nashville when people are actually visiting in the fall. Goodness gracious, it's beautiful with the views. Then you're really targeting and you're kind of staying ahead of the algorithm, and people can really get excited, and it doesn't take that much to go get some photos, some decor, depreciate it, and then recycle your listing just like we have to do in residential. Sometimes you have to change the photos and mess with things and tinker. I do want to thank our wonderful sponsor for breakfast this morning, Vacasa. And please connect with Shannon. Her QR code is there, so scan it and connect with her because they do really maximize your revenue with their property management. And they know what they're doing because they do it nationwide. And then she is your rep here in town. If you want to take pictures of all of our experts here, there is their website. A lot of their websites have great information on them, emails and phone numbers. So make sure you connect with us afterwards, and then I'll open up the floor for some Q&A. All right.
I have 2 unrelated questions. The one, Sharon, you talked about the window and window height. Is that going to be? Does it have to be like 2 feet from the floor? Isn't that kind of like
It's
the skincare stuff?
4 feet from the floor, 48 inches the windowsill. And it's a pretty, the height and width of the window is pretty much 24 inches by 24.
It's bigger than you would think.
Say the number.
I can send you the codes for that, or the
Okay.
Right, it's
Well, I
probably
can look it up. I just didn't know.
it's a little difficult to email. Yeah,
Okay.
but anyway, the window's bigger than you think.
It's on the AI too.
Is it?
You
Okay.
can ask them what they're
I'm going to ask AI.
The other question is, you mentioned Oak Hill and about me not doing it, and East Nashville is impossible. Can you talk about some of the areas? Would you name the areas that are the 3 easiest to be able to actually get not owner occupied and then owner occupied?
Yeah, so it's not necessarily that it's the easiest. It's by zoning, right? It's a commercial zoning. It's mixed. So East Nashville actually has a lot of mixed use zoning, a lot of MUN zoning, which you can do this in. Yes, but there's also a ton of churches in East Nashville, and parks and daycares and schools, and so you have to be very careful. And that's measured from property line to property line. So it's not structure to structure like the beer law. It's property line to property line. So it's a pretty good radius off of each of those things. There's probably more non-owner occupieds in East Nashville than anywhere else on the planet. So there's a ton in there. What I will say is, like, I get the phone call all the time from people from out of state saying, I want to buy a single family home, Airbnb to rent out. And it is incredibly rare for a single family home to be zoned commercial in an area that they want to be in. That is also not very, very, very expensive. Right, like for instance, if you want to buy a single-family home in Germantown that's zoned commercial, it starts around $1.5 million, and that's probably a 2-bedroom, might be a 3 if you're lucky. And so other uses can be higher and better uses for those properties. So like retail, certainly pays more. Law firms for their offices pay more. And so to be careful with that. And so I would simply go by zoning, and I would ask that GPT, where is that available? And I'll tell you. But I will say this, the other question is what gets the most rents, right? Everyone always asks that. The answer is it's almost always proximity to Broadway is really the big driver there. If you have a rooftop with a view of downtown, that helps a ton. If you are in a walkable area, or your building and or community offers a lot of amenities like a pool or a gym or a lobby or a coffee shop, that is very appealing as well. So so expect to see more resort style developments coming up in the next iteration as this market matures. I know the one in East Nashville, as a matter of fact, on Fatherland and South 10th that's coming up that I don't know who's going to be listing, but Richland is building it. That one's got 16 units that surround a pool with a gym with a cool thing that's walkable to 5 points. That one's probably going to crush.
What's interesting is, Airbnb started as, you have the option of staying in the room next to you, right? And then when I started in this business 7 years ago, vacation rentals, it was the residential homes for the most part. And now in Nashville, just in 4 or 5 years, it's the short-term rental buildings, zone NUN. And not only that, now they're being built with pools, fitness centers, parking. So they're really trying to be more hotel-like, which is the complete opposite of how Airbnb started. But that's just the maturity of the things.
And that is one reason why we have this Airbnb seminar under our commercial committee, because it really has turned into more of a commercial investment product. And we are going to be seeing more and more boutique developments. One thing that the Association of Realtors is trying to figure out is, instead of our current zoning, how can we maximize different use types and design in the future, instead of just it's commercial, residential, that there are these overlay areas, there are mixed uses. How does that change as our city grows? And Greater Nashville Realtors is doing a great job figuring that out so that we can get changes made that then increase your overall property value. Because the more flexibility you have, the more you can shift with the market and the more you can do.
I'm with you. First was for Chris. Can you go back and then past batch terms to maximize some of these benefits if we're not aware, but if we have not been aware of them in prior years, and how far can you go back if so?
Yeah. So we actually did ours. You feel there's one form you thought you can do it called a change in accounting principle, and you can get it today from 2 years ago, wherever you want.
Yeah.
Well, 2 is not the limit. I don't know the exact limit of how many. I can find it out. But yeah, you can absolutely go back and get from other years if you had bought one and had not depreciated it. Sometimes you may not. My very first one, I didn't want the full 250,000, 25% depreciation. I had made enough I didn't want to offset every dollar because I knew that value could be better used in the next year. So I offset it down to where I only own, my effective tax rate is 5%, right? If I'm at a 37%, I want to get rid of it. But if I get down to 5, and so be it. If I can get next year down to 5 as well. So you really want to talk to an accountant about the nuances of how much you want to utilize of that and how to best, but you can absolutely file something, take it back, file a form to get it back in prior years.
Yeah. Second question, 2 dwelling units on one site. Would you recommend listing those together to be put together or individually?
So both. So you would have, we call them child listings and parent listings.
Okay.
So 2 child listings of a 4-bed and a 4-bed, and 1 parent listing of an 8-bed.
Yeah. In this particular instance, it's a property that my brother owns, but I've got a tiny house in the back. So that would be a little bit of a different type of experience.
Yeah.
Smaller guest count, right? So just trying to figure out how to maximize that opportunity.
Yeah. So the 3 listings gives you more shots at, more bites at the apple as well, rather than just having 2 listings. Gives you an opportunity for more unique photos, more unique descriptions. You got a better shot.
But also, your smaller unit is booked, then the parent unit is blacked out.
Gotcha.
Yeah. The system knows when it's booked, and then it knows.
Cool. All right. The final one is midterm rentals. Do you guys know of any property management companies that specialize in midterm? Are there some benefits to midterm from a tax perspective that maybe better or worse, for than short-term rental? I have a basement apartment under my home. I've found that I have the best of intentions when I did a really extensive gut job, but I haven't written down as much as I thought I would because I'm sharing space with that person. And so I've kind of found like a midterm might be a better suit, like a better fit for me personally living above it.
Yeah. Well, so from a midterm, you can lose the bonus depreciation because now potentially you're over the 7-night stay. So it has to be 7 nights and under to be able to utilize that bonus. But if you get a month-long midterm and then single, one night, you can still get to under 7 depending on how that mix shakes up. And I see a lot of people that has great success. I just stayed in a month-long midterm rental because we had a leak and our insurance company paid them an absolute fortune. And I was like, wait, why do I not have these? So yeah, I mean, you can absolutely do great with the midterm, but are you trying to also add that tax benefit? You may not get it. But if you're not getting the short term, midterm may be your best solution. I hear there's different, not just VRBO, Airbnb. There's another one. Thank you. Yes, furnish finders. I don't have them, so I don't use them.
Yeah.
A lot of people find furnish finders, traveling nurses use it a lot. But there's absolutely midterm.
All right, we've got time for one really quick one before we're gonna have to give up our room.
I just needed a definition of the DSCR loan.
Yeah.
What they are.
Debt service coverage ratio. Yeah, is what it stands for. Yeah, go ahead.
Yeah, it's debt service coverage ratio. It's just really the revenue divided by your payments is really what the ratio that they're looking for.
They're underwriting the business, the opportunity, and not underwriting the individual. That's the difference. So it's not, what this person's credit score or how much, it's not that. They're underwriting the opportunity.
What happens a lot, once you buy 2 or 3 of these things, all of a sudden your income can't support another mortgage, right? So then they move over to the DSCR because it can support itself based on data. And so that's what they use.
And they have certain lenders who do these type of
Yeah.
Dozens.
Not
Lots of it.
Lots.
Yes.
Fantastic. Well, thank you all for being here. I will be sending out our replay video and slides for review, and then copies of any of the resources are located in those slides, so you can find these different things. Hopefully you got one of Grant's handouts. I've got some additional handouts that will be going out. Share with your friend and also keep in touch with us. We'd love to hear from you and have you as clients and help you out in any way we can. And then stay connected if you're doing a deal.